Welcome back. You're still tuned into Trading Hour, and let's talk about another important story that came through this morning. This one is on SEBI ordering AIFs to offer direct plans. They've also, in fact, put in place a new model which is for commission. So Sonal is here to round up all of that news for us. Sonal?
Thank you so much for that. Yes, it's an important update after the consultation paper that SEBI floated in the month of February. Now in a circular, they've gone ahead and said that yes, now AIFs will have to give an option of direct plan to the investors, which would involve no distribution fee or placement fee to any investors. So that is on the direct plan side. This option has to be given to investors by the AIFs in order for them to invest here as well. Now, AIFs that invest in AIF investments which are made via a SEBI registered intermediary will be onboarded via a direct plan only as per the circular. Now, this is on the direct plan. The second change that they made here is in terms of the commission that is paid as well. In terms of this, category 3 AIFs, which is the third category, will charge fee on equal trail basis to investors, and there will be no upfront distribution fee here. For categories 1 and 2, there will be only 1/3 of distribution fees which will be paid upfront, and the rest can be paid on trail basis. So this is the news and applicable from 1st May as well. Now, why have they made this change? This is in order to ensure that there is no mis-selling and double charging of fees to investors in the current regime. As per the current fee structure, investors looking to invest in AIFs, they are prone to double charging of fees. One is, of course, via the investment fee by the investment advisor, and second is through AIF distribution fees. So in some cases, this could actually contribute around 5% of the total investments itself and become a big chunk. With this change that has come about, this would be done away with, as the distribution fee will not have to be paid by the investors via direct plan. Now, as I said, it was back in February when SEBI had come out with this consultation paper, and this is the reason why this change has come about. Now, just to give you a perspective, upfront fee is where it is paid to the broker in the same month as purchase of the fund, while trail commission is paid every year until investment is withdrawn. So now it will be done over years. So that will, of course, give some support to the investors as well.
All right, Sonal, thanks very much for explaining all the new regulations to us, and they come in effect from May this year. The only thing that hasn't happened, Pavitra, like mutual funds, is that at least SEBI has not yet said exactly how much commission can you pay out, which is very strictly regulated and mandated in mutual funds at least. Well, let's take this conversation forward. We have two guests joining in, and they are from the industry. Nishant Agarwal, Senior Managing Partner and Head of Investment Advisory at ASK Private Wealth, as well as Anshu Kapoor, President and Head Private Equity at Nuvama Asset Management. Gentlemen, thank you very much for joining in. So we have someone representing the asset manager, the project manufacturer here, as well as someone who's representing, of course, the interests of the end client or the end investor. So let me start with you, Anshu. Does this, first of all, create any kind of, fear in the minds of the AIF world that there could be a lot of regulation here? As I said, they've not yet, they've stopped short from saying how much commission can you charge, but they're saying direct plans have to come in, commission at least in some category of funds has to move to a trail model. Your first thoughts?
Hi, Surabhi. Yes, I think our view is that any regulation that is good for the investor is good for the industry. So I think we welcome these changes. The regulation, the framework is progressive and proactive. It does provide for transparency, and transparency in any industry is great. It also allows product selection choice to be made purely on merit and not on distribution fee. So that's a welcome step. And finally, it does recognize the fact that there are some categories in the AIF category which may need a little bit more flexibility to pay out a little bit higher upfront to progress or spur the growth of the category. So I think these are all welcome changes. We wholeheartedly support these, and we'll go into more details as to where there could have been a little bit more from an industry point of view, but overall, very, very positive.
Okay, Anshu, just to follow up, I mean, that's a good, I think, in principle opening statement that you're making. You're in agreement with the way the regulations have come about. But help us get into the granularity, again, from the perspective of someone who's managing an alternate investment fund. Where does this start to pinch? Because in category 3 funds now, you can't give any upfront commissions at all. So will it sort of pinch the growth of the category? And again, even category 1, category 2, you can only give upfront up to 1/3, 33%.
Right. Yeah, so we can go into detail, Surbhi. So as far as category 3 is concerned, the regulator is very clearly saying that there should be no kind of differentiation in similar kind of products. The choice of vehicle should be independent or should be purely based on merit. What it means is that if you're buying a long only product, if you buy it in a AIF category 3 or you buy in mutual fund or in a PMS, the distribution fee should have the same logic, and which is a welcome move, which kind of makes sure that the clients are offered products purely on performance. So a lot of long only products that were offered on category 3, if they will do well, is when the distributor will pick them up now. So it kind of levels the playing field across vehicles for long only products. There's a small category of products which are hedge funds or long short, which are also clubbed into that, but that's anyways are differentiated products. So from that point of view, it is a great thing. As far as category 1 and 2 is concerned, there is some more flexibility given by the regulator on structuring the distribution fee, which states that a little bit higher upfront can be paid. It's a welcome move. The fact that these are all largely 7 to 10-year products, closed-ended, are asset classes like private equity, venture debt, private credit, real estate, and all, which are anyways hard for investors to access or inaccessible, and are a little bit more complex to explain from a sales point of view. So therefore, it's a welcome move. The regulator does recognize the fact that this category needs some help to spur the growth. It's a more involved sales process. My personal view would have been that a lot more structuring, flexibility in structuring would help this category. It's a very small category per se. All three categories put together.
Okay, seems like we have some trouble with that. We're going to try to reconnect. But in the meantime, Nishant, let me get you in also on this for, the other perspective as well. SEBI had first announced this on PMS, so a lot of the distribution efforts moved to AIFs. Now, with this coming into AIFs, tell us from a private wealth player perspective, how much of a negative is this? Because, of course, anyone who is big in the private wealth space will be affected, right? Since it is affecting your commission so directly.
Sure. So I would say private wealth offers services to clients on two platforms. One is the distribution or MFD platform, and second is an investment advisory platform. I think this is a very, very positive news for investment advisory business or investment advisory platform, because for a long time, AIF was the only category left where there was no direct plan available to clients who were paying fees to their wealth advisor or wealth manager. Earlier, it was mutual funds followed by PMS. And only AIFs were left which only had regular plan. And like you mentioned, investor was paying double fees. First the full fees on the plan and then the advisory fee to the advisor. Now with an option of direct plan being available, there will be a resurgence of a lot of investors coming towards investment advisor and all products being available on direct plan. So the platform has been neutralized. That's the differentiation which has gone for investor, and it's a very, very good change. I would say even for the distribution platform, the impact may not be as big as it is thought. A lot of this was already being planned by asking for trail commission even when upfront was available. So to service the client over a long period of product, 5 years, 6 years, 7 years, you need to be involved in the product. And us and many other players in the market were anyways preferring a part upfront and part distribution commission when we were offering AIF to investors. So this is in line with that. Lastly, on category 3 AIF, in the medium to long term, it might turn out to be better for wealth manager, because please understand the upfront commission was only paid on commitment amount which the investor commits to an AIF, let's say category 3. However, when the trail commission comes in play, you get the trail commission based on the NAV of the product or market value of the product. Typically, if we expect a 15% growth in a long only equity product every year, then the value of the investment grows from 100 to almost 150 over a 3-year period. So your trail also gets increased, like customer expenses increases on commitment on market value. Similarly, the trail goes up. So it's a short-term negative impact on the part of the fees, but a very, very welcome and positive change for investor and the category over medium to long term.
Okay, got that. Stay on, Nishant. We have more questions for you. We'll get into a very quick break and continue this conversation on the other side. Welcome back. You're with us on Trading Hour, and we are discussing the impact of SEBI's latest recommendations for AIFs, or alternate investment funds. These new regulations kick in from May this year. Nishant, to get back to the conversation, help us with the numbers and the data, because the industry is really opaque and we don't have sort of, quarterly or monthly listings. What would be the total size across category 1, category 2 and category 3? Which category is the biggest? And are there a lot of people coming through the direct channel at all? Isn't it all or most of it distributor-led or maybe advisor-led? And again, what's the breakup between pure advisory and distribution?
Sure. So basically, between category 1, 2 and 3 put together, the industry is around 7 lakh odd crores. But the industry can be broken into 3 buckets. One is all the institutions, the insurance company, the banks, the global funds, which comes directly through fund managers' contact, and there is no distributor or domestic advisor which is involved. So that's a category which will get affected, because currently they pay only the one fee plan which is available in all these AIFs. And now when the direct plan are there, the AIF manager might be required to offer the direct plan to these institutions which come directly to these advisors. We have to see how that evolves. The second category is the HNIs and domestic investors. There are 2, I would say, categories by which the investor come in, one through an intermediary and one directly to the fund manager. The intermediary business is driven between distribution and investment advisor. And I would say currently, more than 90% of the business is under distribution fee-led business. Only 10% is investment advisory, very, very broadly speaking, because there was a kind of, I would say, differentiated fee structure and there was a double fee. The AIF was not moving clearly into investment advisory. So 3 categories. Institution business will impact the earning for fund managers, because those institutions will now ask for direct plan. And under the non-institutional business, it will be a mix of distribution and advisory. And it will be more of advisors who will be recommending direct plan instead of distribution plan going forward.
All right, got that. Just a little bit more of a zoomed out question on what we could see in the next few days. Anshu, coming to you now, do you think up until May 1st, when this, actually comes into play and you do have to follow these new rules, do you think we're likely to see a big rush into this category just on account of, a lot of these private wealth players pushing the AIF harder?
Well, it's unlikely. These are very involved sales process products. So it's unlikely that suddenly we'll see a big rush. I think overall this category is still very, very small. There's a lot that needs to be done for awareness, information and education. And anyways, total number of investors are very small per se. So it is not a widely distributed product. So I don't think there'll be a flurry of activity over the next 20 days.
Gentlemen, before we wrap up, I come to the point from where I began. Right now, there is absolutely no talk of regulating commissions in terms of how much money can be paid out. That's an entirely market-driven, industry-driven process. So leave us with some thoughts. Anshu, what are ballpark commissions like? And will this move result in commissions coming down at all, commissions going up? What happens?
So maybe I can answer this in 2 parts. Surabhi, if it's okay, I don't know, because I got dropped off. I actually wanted to make a point on the direct plan first. The point is that today AIFs cannot be marketed or promoted extensively. And therefore, my view or suggestion to the regulator is that if we are introducing a direct plan, and it's a step in the right direction, also help us create tools for investors to find, analyze and evaluate these products. I think that will help the industry per se. Coming to your question on the point of whether the total payouts and all will increase or decrease, I don't think much will change. It's just that the total economics will remain largely the same. So let's say if it's a 5 to 7 year product and the total fee pool, management fee is 8%, and if about half is being shared with the distributor, the payout terms will remain the same. As in, let's say if half is paid, for 4% is shared with the distributor, now it's being shared with the trail model or as per the category. So my view is that not much will change from a total economics point of view. But I think overall confidence of the customer will grow, and therefore overall revenue pool for this asset class will increase.
Okay, all right, got that. Gentlemen, thank you very much for making sense of these new regulations for us. And of course, we'll touch base with you again once they're rolled out and see how industry and investors are adapting to the new normal. Thank you for joining in. Well, Pavitra, with that, I guess it's time for us to leave as well.
Let's do that. We're going to wind down. The market has come off a little bit, I have to say, and that's largely on account of what's happening with big tech, right, ahead of the earnings season starting. But that's all on this edition of Trading Hour. You guys stay tuned. Halftime report up next.